Okay, so today, Stephanie is back to our platform. She's not new to us. She's with Hanover Bank. She specializes in doing SBA fundings, and we actually doing a lot of deals together. And the first time that she came onto our platform was sometimes in January, and she gave out the basic of SBA. So tonight she's here again to share with us the SBA eligibilities. How can you filter our clients? Why some deals are not working? Why some deals are working? So on and so forth. So she's going to open up the hood and let everybody to see underneath of the engine what exactly is going on behind the scene. So without further ado, Stephanie, the floor is yours.
Good evening, everyone, and thank you for taking the time to be here. Today, I'm going to be talking about SBA eligibility, specifically what kills deals early and why strong pre-screening is one of the most valuable tools we have as lenders, brokers, and advisors. The presentation is not about underwriting or credit memos. It's about deals that never even make it that far, and more importantly, how we can prevent that from happening. So why pre-screening matters. Most SBA declines happen before they even hit underwriting. Eligibility issues are predictable and avoidable. Strong pre-screening saves time and resources. It creates faster approvals and better borrower experience. The goal here is fewer ineligible submissions. So most SBA declines don't happen deep in underwriting. They happen before underwriting even opens the file. Eligibility issues are usually predictable, preventable, and visible early if you ask the right questions. When we pre-screen correctly, we save time for everyone involved, less back and forth between the borrower and the bank, faster approvals, a better experience for everyone, and fewer dead-end submissions. So the goal here is fewer ineligible submissions and stronger deals going forward. So from the borrower's perspective, there is, nothing worse than spending weeks gathering documents, paying for third-party reports, and emotionally committing to the deal only to be told later that they were never eligible in the first place. So from the lender's side, eligibility mistakes slow pipelines down and waste underwriting resources. So if we can identify red flags early, we can either restructure the deal, redirect the borrower to a more appropriate product, or stop the process before unnecessary time is even spent. So eligible versus ineligible businesses. Eligible businesses for SBA loans are for-profit operating businesses. Their primary purpose is eligible under SBA rules. Business activity is clearly defined. Red flags are, shell type companies and passive entities. So, if it's an investment type of business, that's most likely not going to be SBA eligible. The business must actually provide goods or services. Revenue must come from operations, not from holding assets. The business purpose must clearly align with SBA rules. Entities formed only to hold real estate, or like I said, shell companies with no real operations. Those are red flags for you to look for. Some other ineligible businesses to look out for: investment or speculative businesses, passive real estate holding companies, lending, factoring, or investment firms, gambling or adult-oriented businesses, any marijuana-related businesses, even if it's legal at the state level. Unfortunately, SBA follows, federal guidelines, not state law. So those are some businesses to look out for. Passive income and real estate traps. This is one of the biggest deal killers. SBA loans are not designed for passive income. That means rental income, royalties, investment real estate, holding companies. For example, If a borrower owns an operating business and a separate entity that just collects rent, we need to be careful, about how we structure and cash flow. Another common issue is a borrower wants to buy a building, lease out the majority of it, and only occupy a small portion. The borrower has to occupy at least 51% of the building. Otherwise, it doesn't qualify for SBA. New construction is minimum 60% owner occupancy. Triple net leases are not allowed. The operating company must be the primary borrower, not a passive real estate entity. So a frequent pitfall there is when borrowers want to maximize rental income, that usually kills SBA eligibility.
Stephanie, do you mind if I ask a question right here just before I forgot?
Sure.
So you mentioned about passive income that we got it, right? So what about hotel and Airbnb? How do you see business like that?
So hotels are different. Hotels are eligible for SBA. Airbnbs, that's more lender by lender. Technically, Airbnbs are SBA eligible. We don't do Airbnbs at Hanover, but technically Airbnbs are SBA eligible.
Okay. Thank you.
Mhm. Sorry, I skipped a few slides here. So ownership and affiliate rules. This is another tricky area. So all 20% plus owners must be disclosed, and they have to guarantee the loan. Also, all affiliates must be identified. Sometimes, even if a owner is not 20% or more owner of a company, they're still considered an affiliate through common control, family relationships, management overlap. So if this is a good example. Hotels are a good example of this. So a lot of times we see a lot of hotel ownership structures where it's a family and they all share ownership 5-10%. It could still be considered an affiliate if that person has management control over the decisions of the business, control over the bank accounts. That entity may still be considered an affiliate. So you have to watch out for affiliation because affiliates can break SBA size standards. That's a big trap that I see a lot. Is they're not eligible because they don't meet size standards because of affiliates. So that's something to watch for as well. Citizenship and residency requirements. So this is a hot topic right now in the SBA world because, as a lot of you probably know, that there was just a recent change to the citizenship and residency requirements with the SBA. So currently, as of March 1st, the new rule that was just published recently will become effective March 1st. 100% of the borrowing company has to be owned by U.S. citizens or U.S. nationals. So visa holders and green card holders are no longer eligible for SBA funding. So there's no exceptions or workarounds on that one. So that's another issue to watch out for. So some key pre-screening questions that you want to keep in mind when you're talking with your borrower is, how does the business generate revenue? Is any of that income passive or rental? Who owns the business, and do they own other entities? Are there any affiliates? Are all owners, U.S. citizens or U.S. nationals? So if you can confidently answer these questions early, you're going to eliminate the majority of the eligibility issues that we see here at the bank. Eligibility issues are the number one SBA deal killer. Most problems surface, like I said, early on if you ask the right questions. So, asking those pre-screening questions is really important. It's imperative so that, you don't get deep into underwriting and these become issues, or you get to the closing table and these issues arise. And not only have you wasted, the borrower's time, the lender's time, and then, it damages your reputation as a broker. So with all of that being said, I just wanted to take some time to just open it up to any questions that anybody might have, any specific questions that I can answer.
Stephanie, let me start the questions. And by all means, anybody, if you have any questions, either you can raise your hand, jump in, or type in the chat box. Okay. So the question that I have is how many years a business need to be in operation in order for you to consider somebody saying that it's a 1 year or a startup or a few months? What is your take on the time in operation?
So in general, most lenders like to see 2 years of business tax returns. It varies from lender to lender just because, some lenders are open to startups. So we don't do startups here at Hanover. We will look at franchise startups, but we're not really inclined to startups here at Hanover. So we like to see 2 years of business tax returns.
So is that a minimum for you?
Yes.
Okay. So you mentioned that some other bank does startup. So I would imagine that some other bank would be interesting to look into businesses that has only 1 year tax return or less than 2 years tax return, right?
Yes. So from lender to lender, that varies. I know some lenders, some larger lenders like Huntington Bank, Celtic Bank, US Bank, they do startups, they do projection-based lending. So, it's important that you know your bank's credit box, and which lenders look at startups, which ones don't, which lenders do projection-based lending, which lenders will only lend based off historical cash flow. Here at Hanover, we just recently had a change in our credit box. That's the other issue too, is that lenders are always adjusting their credit box according to market conditions. So we just had a recent change here where we won't do projection-based lending anymore because of some losses that we had in our portfolio. Mm-hmm. But there are a lot of other SBA lenders out there that will do projection-based lending. So it's just knowing your lender's credit box.
Right, correct. Another question that we have is you mentioned about what other businesses that they have. So we oftentimes run into a situation where the client, let's say client A owns a restaurant, and now he wants to open another business with client B. And yet client B also owns his other businesses. So from your perspective, do you need to look at their other businesses also? What kind of financial are you looking for in this case?
So if the borrower owns 20% or more in another entity, that is going to be considered an affiliate. Or if they have significant control over that business, like I said, in the case of, a lot of times with hotels, a borrower may only have 5% or 10% ownership in that hotel, but they have management control, meaning they can hire and fire people. They have control over the bank accounts. That could still be considered an affiliate. But what we look for at the bank is we look through the guarantor's personal tax returns, and we'll generally have all of the entities that they have ownership in listed in their personal tax return schedules. And so then we'll question them about their ownership percentages in those entities. And if they do have 20% or more ownership, we, determine that they do have affiliation, then we're going to want to see 2 years of tax returns and a recent interim statement for that affiliate. And the purpose for that, it's an SBA rule. It's not a bank rule. It's an SBA rule. And the reason why the SBA wants us as lenders to look at affiliates is one, for size standards. And then secondly, we want to see if there's major losses with those affiliates, because sometimes affiliates can be drains on the operating company. So, those are all things we have to take in consideration when we're doing the cash flow calculations.
I see. What about credit score? What kind of credit score are you looking for?
So in general, most lenders want to see a credit score minimum of 680 for all guarantors. However, sometimes we can make exceptions down to 660 if there's significant explanation for, their credit. Maybe they recently went through a divorce, or they recently had a major illness where, they were out of work for a substantial amount of time. Sometimes we can, be granted an exception for that, but the majority of the lenders out there want to see at least a minimum of 680. Also, too, it's taken into consideration if you have one guarantor in the transaction, and he has a lower credit score, versus if you have multiple guarantors. Say you have 2 guarantors and one has a really strong credit score of 720 or higher, and the other has, a 660 credit score. We'll take an average of those 2 scores. So we do take that in consideration. But generally a minimum of 680.
I was told that there's another type of credit. It's called E-Trend. Is that, are you familiarized with that credit score? Or is that a business? Is that
I think what you're thinking of is the SBSS
yes.
score. Okay, yes. So that is actually, which they just did away with that. SBA actually just did away with that.
Hmm.
They used to use that score. It was a business score for SBA Express loans. That's how SBA Express loans of $500,000 or less were scored. But the SBA actually just got rid of that scoring model. And so even Express loans now have to be fully underwritten by the lender. Some lenders used to approve small loans just based on that score, and they didn't do any underwriting. They didn't collect documents. They didn't do any underwriting. And there was major losses with the small loans. So that's why the SBA did away with that scoring system.
Understand. Yeah, that is the small loan is always the one that it's having a hard time. We're having a hard time to look for funding. We experienced that before. Well, since we're talking about the loan amount, what is the minimum loan amount that you're looking for?
So at Hanover, we generally want a loan of 350 or higher.
Yeah.
We will look at, lower loan amounts for real estate, but it's more on a case-by-case basis. But generally 350.
Okay, got it. Now in terms of the upper amount loan limit, we all know that SBA uh, 778 and they can go all the way up to 10 million. There's a type of loan called SBA Green SBA loan that can go more than $10 million. Can you share with us a little bit about what that is?
So I think what you're thinking about is, so there's the SBA 7A loan, we can go up to 5 million.
Hmm.
And then SBA 504 can go up to a 5.5 million.
Hmm.
And then the SBA Green 504. So the SBA Green 504, it can go up to 5.5 million as well, but it's separate from the regular 504 program. I actually, well, it was a deal that we were looking at together.
Right, it's a construction deal. Yeah.
Right. So the borrower already had used the 504 program to finance his other hotels, and he had
Yep.
maxed out his SBA guarantee for 504. But if he did a SBA 504 green loan, he could get another 5.5 million under that program. So it's just exactly like the regular 504 requirements, except there has to be, as a part of the project, something that is adding sustainability to the project. Like in his case, he added solar panels
Right.
to the hotel.
Right.
So, that was, it has to be certified by a specific company
Mm.
that the SBA uses to qualify for the 504 green
Mm.
program. But that's how he was able to qualify for that program and get the additional SBA funding,
Hmm.
was by adding solar panels to his new hotel.
Right.
So that's a good example of that program.
Mm. You mentioned, yeah, while we're talking on this subject, how many SBA loan a business is allowed? Because again, I mean, is that a number or dollar amount? So if somebody that already have an existing SBA loan, are they eligible for to get another one?
So the maximum, they can get multiple SBA loans, but it just depends on the amount. I've seen businesses have, 4 or 5 smaller SBA loans at one time. They cannot exceed the 3.7 million guarantee maximum. And the 3.7, so the 3.7 guarantee maximum is calculated off just the SBA guaranteed portion. So let's say, for example, you have a $5 million, SBA
Mhm.
loan. So out of the 5 million, 75% of that is going to be guaranteed by the SBA. So that's your 3.75 million. So one $5 million SBA loan is going to max you out for your SBA guarantee.
Mhm.
Because that portion, that 75% hits that maximum guarantee. But, if let's, say you have $1 million SBA loan, 75% of that would only be 750,000. So, you still have another, let's see, 3 million left in the SBA guaranteed portion that you can utilize. So that's how that works. So yes, you can have multiple SBA loans,
Mm.
but you can't exceed that 3.75 million guaranteed portion.
Understand.
That makes sense.
Yeah. Um, Again, we run into situation where client has loans such as PPP, EDO
Mhm.
loans that has not been paid off. So share with us a little bit when you look at when you underwrite the loan, when you found a client has something like this, do you require them to pay them off before you fund them?
No, we don't. As long as they can still meet cash flow, we still calculate them into the debt service
Hmm.
coverage ratio. So there's that debt's still included in the overall cash flow calculation.
Mm,
But we don't require them to pay them off, and we as long as they're not in default.
right.
So as long as they're up to date and they're not in any default.
Can you take them out? Meaning that if they have a loan like this, or not necessarily PPP loans, right? Let's say if they have equipment loans or any other debts, credit card debts, whatever that might be associated with their business. So when they apply for an SBA loan, can you pay off their existing debt using SBA loan?
So it depends on the debt. We don't refinance SBA idle or PPP loans. We cannot refinance MCA debt.
Hmm.
That's that we used to be able to, but that
Hmm.
changed last year.
Hmm.
So we can no longer refinance MCA debt. Hanover actually has a rule. We don't want to finance anyone that's ever had MCA debt
Mm.
because what we find is borrowers that have had MCA debt previously tend to fall back into it. Uh, they
Mm.
go back to it, even if it's currently paid off. But we can refinance other SBA loans, um, any other business debts, lines of credit, term loans, um, business credit cards, as long as the credit card is solely used for the business and it's not mixed with um, personal debt. So pretty much anything else besides MCA debt, idle loans.
And you can also refinance equipment also, right?
Yes, we can refinance equipment.
Can you cash out equipment? Let's say they already have equipment that is free and clear and they need some funding for it.
We don't like to do cash out refinances. Um, we can we can use it as collateral for
Mhm.
working capital, but we want to know what that working capital is going to be used for, what the use of funds are going to be, and to make sure that the use of funds is SBA eligible. So generally, as long as you're using it for business expenses or um, something of that nature, it's generally SBA eligible. But we just don't want to give, straight cash
Mm.
to a borrower and, not have a documented
The
use
usage
of
of the fund.
funds for
Right.
that.
Okay. That makes sense. Um, along the way, we had a few deals that got denied just because they don't have any real estate collateral with Hanover. Can you
Mhm.
explain that? I think that's just with Hanover, right? Can you explain that a little bit?
So with the SBA loan, again, most SBA lenders underwrite according to the SOP, the SBA SOP rules and guidelines. But each lender also has their own individual credit policy. So we have to follow SBA rules, but then each lender has their own guidelines. So, like I said, that varies from lender to lender. Some lenders are more conservative than others. Some of the larger lenders, they will, take more risk. Like I said, they're
Mhm.
more apt to um, do projection based lending or startups.
Mhm.
So that's what's really important to understand each individual lender that you work with's credit box. Um, an SBA loan doesn't have to be fully collateralized. That's one of the most common reasons why um, a loan will go SBA, because in conventional lending, they want it to be fully secured. But in SBA lending, you're allowed to have collateral shortfall. But most lenders, depending on what the use of funds are for. So, for example, for real estate purchases, we don't want to go higher than 85% LTV. Sometimes we do, but in general, we want to stay at 85% LTV. When you start looking at deals that have no collateral at all, that's where the real issue comes in. Because you're basically, you do have the 75% SBA guarantee, but if you have no collateral at all, sometimes, you can't even take, in certain states like Texas or Florida, you can't even take personal real estate for collateral. So you're just left with, not really much, to speak of as far as collateral. That's when you can have major issues with, lenders not wanting to fund it. But yeah, it's very common for SBA loans to have some sort of collateral shortfall. So
I noticed that sometimes the SBA require the clients to purchase a life insurance. Is that what is the purpose for that? Is that for collateral or for protection?
yeah,
What is it?
yeah, it's for collateral purposes, and in general, if you have a sole owner, then you're almost always going to be required to have a life insurance policy, unless you can show a strong plan for moving forward. How's the business going to run if you have a sole owner and he's pretty much responsible for running and operating the business, and he were to pass away, what's the transitional plan if he were to get hit by a bus tomorrow? Who would take over the business? Would the business shut down? So if the borrower is insistent they don't want to provide life insurance, or maybe they can't, some individuals, they can't get life insurance because of health issues. My advice would be, if you can submit a business plan of how the business would continue to operate without that individual, who would take over the business. If you can't show that, then that could be a hard stop.
Right. Okay. Um, let's talk about another questions that we have. So let's say somebody that purchased a building, open up a restaurant, whatever that might be, right? So they got funded for SBA. And normally for SBA, the loan term is 25 years. So what would happen along the way? Let's say the business shut down. He cannot run the business inside of that building anymore. But however, he decided to rent out that building. What would happen to the loan? Would that trigger any callback or anything would happen?
Yeah, so I think I understand what you're asking. So let's say a borrower purchases a building for his
Yeah.
operations, and 10 years in, he decides that he doesn't want to, continue with that business, or, his business goes under, he wants to rent out that building instead,
Right.
to a tenant. So if he's not at least occupying 51% of that property, and by 51%, I mean 51% of the square footage, then he would be in violation of SBA rules, because under the SBA SOP, the operating company has to occupy 51% of the property. So if the lender or the SBA were to find that out, then it would automatically trigger a default on the loan. So yes, they would call back the loan. The lender would lose their guarantee and they would foreclose on the property.
So I guess my next question is that how would they find out? How would the bank find out if as long as they're paying for the mortgage or the note?
It's not guaranteed that they would. The SBA does regular audits and site visits. So it could slide under the radar. There's no guarantee that they would find out, but like I said, they do random site visits and they do audits. So they very well could find out. Us as lenders, we do site visits. So after a loan closes, the bank will go and do a site visit. So,
Okay.
so yeah, things like that do slide under the radar because, there's a lot of SBA borrowers out there and the SBA can't police all of them, but it's very risky to do something, against SBA
Right.
rules.
What about change of ownership then? Change of ownership of the company.
That's another issue too. So it's not that it's not allowed. It depending on change, whatever the change is. Some changes don't have to be approved by the SBA, but some need to be submitted by the lender to the SBA just so they're made aware of the changes. So that change of ownership after a loan is funded is, not necessarily against the rules. It just depends on what the exact percentage of change of ownership is. For example, if you're 100% owner and then you decide to take a 50-50, a 50% partner, that's allowed. It really should be reported to your lender so that they can report it to the SBA and it can be documented in the file. Just so that if the lender's audited, everything is accurate. Something like that is not going to trigger a default or, cause a problem. But now for an example of something that would cause a problem is, say you're with the citizenship changes, say you buy a business as a U.S. citizen and you're 100% owner of that business and your loan closes and funds, and then 6 months later you try to transfer 50% of your business or even 5% of your business to a green card holder. If your lender or SBA found that out, and that's the issue with that is most lenders will request annual tax returns from their borrowers. So we're still monitoring your financials even after the loan funds. So they would most likely find out a change of ownership from your financials. So something like that would definitely trigger a default on your loan.
So along that line, if you monitor the financial, even though after the loan is done, now again, let's say the business is not doing well, what would happen? Do you call back the loan at that time? Or, I mean, I'm assuming that they're still paying for the mortgage. There's no default whatsoever, but it's just the business is not doing as well as before.
It depends. It depends on what your um, specific loan requirements are. Some lenders do. We don't generally put in loan covenants for our SBA loans,
Mm,
but some lenders will, as a part of their terms, will put in loan covenants saying, basically you have to maintain a debt service coverage ratio of a certain, 1 to 1, or, um, it, like I said, varies from lender to lender. So, that's something that's important, is for borrowers to review their promissory note before they
mm,
sign it, to, make sure they understand all the terms and conditions of their loan, because their loan agreement, because some lenders do put covenants for debt service coverage
mm,
ratio. So if it falls under that,
mm,
um, that could, trigger, a problem.
mm.
Um, but yeah, all lenders service their loans, and they want to see um, at least annual,
Mm.
tax returns, or um, accountant reviewed, you know, statements, so that they can monitor the financial health of their borrowers. So,
Mm. Okay. Um, do you allow a second lien on the building? Let's say they purchased the building for $1 million this year, running the business. 5 years down the road, that $1 million business building becomes, let's say, 1.5 million. And now they need some quick capital, but they don't want to touch the SBA loan. They have a private lender that can come in and give them 100, $200,000 and utilize the building as the collateral and put a second lien position on it. Do you allow something like that to happen?
yeah, they can have a second lien. It's just, it's going to be behind the bank and behind the SBA if it's an
Right.
SBA loan. Um, so
Do you have to agree to it? What do we have to inform you, or they can just that could, because that's happening to many of our clients right now as we speak. They have a SBA loan so many years ago, and now the value is jumped up dramatically,
Mhm.
and they are looking for a second position right now. So do we need to inform the SBA that we are getting a second loan?
No, you don't. You don't have to. It's just that, that lender is going to be behind the SBA and the
Oh,
bank.
okay,
So, um, we'll always be in a first, lien position.
right, okay.
So,
Well,
their other lender has to be okay with that. Some lenders, don't want to be in a second or third position.
right.
So,
Yeah, a lot of this lender are private lender anyway, so yeah. Um, well, anyone, if you have any questions, not just me asking, right? If you have any questions, feel free to jump in. If not, then I would just keep asking. Well, let's get back to the eligibility. Um, you mentioned that the maximum you can do is 85%. So the client need to inject about 15-20% into the project. Can you share with a little bit what type of injection or what type of cash or what type of down payment is allowed? Meaning that let's say they have fund wire in from another business, or they have fund borrow from another partner, so on and so forth. So what is allowed in terms of down payment wise or fund injections?
so generally, for real estate transactions, if they're purchasing real estate, we want at least a 10% injection requirement. Um, it just depends on the appraised value of the
Mhm.
property. It depends on what we have as far as collateral, because we're looking at equipment, we're looking at furniture and fixtures, we're looking at residential real estate as well. That's all a part of the LTV calculation as well. So, they may be at an 85% LTV and still only have to put down a 10% equity injection. So it just depends on um, what we're taking for collateral. If it is special uses, if it's a property that's special uses like a hotel, a laundromat, sometimes funeral homes, if they have a crematorium, bowling alleys, special use properties like that, then it's 15%. It's an automatic 15% equity injection requirement. Though I will say that I just recently heard that there is a bill that was just passed. It's not law yet, so it's not in practice yet. So it'll be interesting to see what happens. That they're going to take away that additional 5% equity injection requirement for special use properties. It's not in effect yet, but that may be coming. But currently, right now, it's 15%. Business acquisitions, also, we want to see a 10% injection requirement. Again, if it's a startup, though, then they're going to want an additional 5% for a startup.
Okay.
So it just kind of depends on, that's the general rule, but again, case by case basis on each individual loan request. If the borrowers aren't as experienced, if, we also look at post-closing liquidity too. So, when they put their, after they put in their injection requirement, what does their post-closing liquidity look like? We want them to have at least 10% post-closing liquidity. So those are all things that we take into consideration as well. But in general, it's 10% equity injection requirement.
Do you care where the 10% come from?
It needs to come from cash, either business cash or personal cash. It can be a combination of business or in personal cash. We really want to see, we can use seller notes. We can count those towards equity injection, but we like to see at least 10% of the equity injection come from actual cash. So either the business or personal, or a business can use affiliate cash as well. So they can, if they're gonna, they can have the cash gifted to them as well. But there's special requirements on that it has to be seasoned in a bank account for 60 to 90 days. There has to be a official gift letter. So there's special requirements with that, but yeah, you can use any combination of business, personal, affiliate cash.
Okay, very good. Let's talk now. Let's say they purchase in another business now, and also at the same time they have a full-time job. Do you require them to be in the business full-time, or can they run the business part-time? So I have a lot of people that say, for example, they are doctors, they're working for a hospital, and now they want to open up their practice. So what is the SBA's rule on something like this?
Again, it depends on the type of business. Some businesses aren't labor intensive. They don't require someone managing it, full time. Like, for example, a laundromat. You don't need to be, the owner doesn't need to be on site on a daily basis to run a laundromat.
Right.
So you have to kind of look at what type of business it is, and also, if it's a business acquisition, do they have existing managers that are staying in place? Are there existing employees staying in place. So, maybe the owner, we like a lot of times to see owners keep their current employment if they can, just because that gives another form of repayment, so they still have that outside income, so they're not completely reliant on the business performance to make their loan payments. If it's feasible. So, what we don't want to see, and I plan on doing another training on just business acquisitions.
Great.
But, what we don't want to see is a business owner that is just completely removed from the business altogether, and they're not going to have any involvement in operating the business. It's okay if they have a general manager, someone that's going to run the day-to-day operations, but we want them to still be involved to a certain extent. We want to, that needs to be a part of the business plan, so we can understand how much involvement they're going to have, and what their role is going to be, versus what their manager's role is going to be, because there's rules, SBA rules around that as well. We don't want to see an owner that lives 2 states away, say, I want to, buy this business that is 2 states away, and I'm never going to be there. And I don't know, I'm just going to buy it, and it's, just let it run however it's, currently operating. That's a major red flag. We don't want to see something like that. But yes, it's depending on the type of business. A lot of times it is feasible for the owner to keep their current employment and still, purchase a business.
Okay, got it. I think this is my last question right here. Okay. Are there any situation where you as the bank approve the loan, but SBA does not approve the loan?
That does happen. It depends on a couple of factors. So, is your lender a PLP lender or not? So,
What is a PLP lender?
PLP lenders are preferred lending partners. So they basically have the same authorization as the SBA. So we can fully underwrite and decision a loan in-house. We still have to submit the loan to the SBA through E-Tran and get our PLP number. But lenders that don't have PLP status, they do have to submit the loan to the SBA before, and get SBA approval before they can close a loan. Since we're PLP lenders, we don't have to
get approval from SBA.
Get approval from the SBA first.
So basically means that when we send a deal to you, you approve it. Pretty much, that's the end of it, and we can expect. Right. Okay. Good.
So, but as PLP lenders too, we're, held to a really high standard. So that's why we're very diligent about, our documents and making sure the file is documented properly, because the SBA does come in and audit our files. And if we don't document our files properly, or we don't, follow specific rules, and we get audited, then we can lose our PLP status. So it's really important, when borrowers are, upset, like, why do you have to have all this paperwork? And, it's because, it's SBA requirements that we have to follow. So.
Totally understand. Well, thank you so much. Stephanie, that's definitely a great conversation. Always talking to you and learn a lot from you as well, and especially open up the hood and see what's under the hood and how the whole thing works. So that definitely helped us a lot. So, ladies and gentlemen, in this room, and hopefully you learn something tonight, understand what SBA is and how they filter out their clients, so on and so forth. So in here in Sequoia, we do, we do work very closely with lenders like Stephanie. As a matter of fact, we talk pretty much on a weekly basis, if not on a day-to-day basis. We run by there's a lot of scenario comes in through you guys, and again, I'm a lot of these deals I don't understand how to structure. And I don't pretend that I understand how to structure. So we rely heavily on expertise like Stephanie and their bank to help us to structure the deal. And that's why we every time when a scenario comes in, the first thing that we do is we will try to understand it first, and after that, then we will get Stephanie online and we start to discuss. And in some cases, we even get you as the agent and and the clients to involve so that we can understand more in detail what this deal is all about. So again, um, to just let you know how we do business in the back end. So hopefully you learn something tonight and you can carry this knowledge to actually to go out there to generate some business. And as Stephanie mentioned, that she's coming back next month in March, sometimes in March, that we need to set up a schedule that she will be talking about business acquisition. That definitely is going to be another very interesting topic that we need to learn. So other than that, well, thank you so much. Definitely, always pleasure to talk to you. And next time I'm in Chicago, love to meet up with you.
Yeah,
Vice versa,
sure.
if you're coming to the DC area, we would love to love to meet up with you as well. Okay.
Great. Thank you so much.
And guys, thank you so much. And next week, we will have another very interesting topic next week. We're going to be talking about how to speed up the property claim. If you remember, around 2 weeks ago, we launched a new program where we can help businesses owner that who has property and they got property damaged, such as fire, wind damage, water damage, whatever that might be. We have a partner now that can help us to file that claim and they can get back much, much more money for our clients. So next week he will be back onto our platform to share with us some tips how we can speed up to get the funding. So until then, thank you so much, everyone, and see you next Wednesday night. Good night.
Thank you.
Thank you.
Have a good
Bye.
night.